Have you ever wondered how to invest in the stock market without constantly watching the numbers? Well, index funds might just be your answer. Diving into the stock market can be an overwhelming experience, especially for new investors. The sheer volume of data, the rapid pace of the markets, and the endless analysis required can make stock investing seem like a full-time job. Now imagine a solution that simplifies this process, making it more accessible to everyone. Enter index funds. Index funds are a type of mutual fund with a portfolio constructed to match or track the components of a market index, like the S&P 500. This means rather than choosing individual stocks, you're investing in a broad segment of the market through a single purchase. This approach minimizes the time and knowledge needed to manage investments and reduces the risk associated with picking individual stocks. So, if simplicity and efficiency sound appealing, stick around to uncover the mechanics of index funds. Now, let's demystify what index funds actually are. Imagine you're at a buffet and instead of choosing individual dishes, you take a little bit of everything. That's quite similar to how index funds operate. An index fund is a type of mutual fund or an exchange-traded fund, ETF, that is designed to replicate the performance of a specific index, such as the S&P 500 or the Nasdaq. These funds hold a collection of stocks or bonds that mirror the components of a particular index. This means that if an index includes stocks from 500 of the largest companies in the US, the index fund aiming to replicate it will hold shares from these companies. Why is this beneficial? Well, it's all about diversification. Diversification is a strategy that spreads investments across various financial vehicles, industries, and other categories to increase the likelihood of return and reduce the risk of loss. By investing in an index fund, you're not putting all your eggs in one basket, but rather spreading your investment across a broad spectrum of assets. This approach can protect you from the volatility that can occur if one stock or sector takes a downturn. Since you own a small piece of each company within the index, your investment is less affected by the failure or success of any single company. Essentially, buying into an index fund is like buying a piece of the broader market. Understanding how index funds work is key to recognizing their value. Let's dive into the mechanics behind these financial instruments and see what really happens when you buy shares in an index fund. Imagine an index like the S&P 500, which includes a broad spectrum of the largest US companies across various industries. When you invest in an index fund that tracks this index, you're essentially buying a small piece of each of these companies in one go. You're not just buying one stock, you're buying a portfolio of hundreds, mirroring the composition of the index. Now, the magic happens with the fund managers. Their job isn't to pick the winners or sell the losers. Instead, they meticulously adjust the fund's holdings to ensure they match the proportions of the stocks in the index. This is crucial because as the value of the stocks in the index changes, the fund needs to be rebalanced accordingly. For instance, if one company's stock price soars, the fund might buy more of that stock to maintain the balance. Tracking error is another concept to understand. It refers to how closely a fund's performance mirrors the index it follows. A lower tracking error means the fund is doing a good job of mimicking the index. This is important because the main goal of an index fund is to replicate the index's performance as closely as possible, not to outperform it. With these mechanics, index funds offer a hands-off approach to stock market investing. Why are index funds often recommended for most investors? Let's delve into their benefits. One of the standout advantages of index funds is their affordability. Typically, these funds come with lower fees than their actively managed counterparts. This is because index funds are designed to follow a specific market index, rather than attempting to outperform it through frequent trading. This passive management style means less work for fund managers, which translates into lower costs for investors. Additionally, index funds tend to have lower turnover rates. Turnover refers to how frequently investments are bought and sold within a fund. A lower turnover rate often means fewer transaction costs, and importantly, lower capital gains taxes. That's because frequent trading can lead to higher taxable income, which is less of an issue with index funds. Another significant benefit of index funds is the built-in diversification they offer. By mirroring a market index, these funds automatically include a variety of stocks or bonds, which helps spread out your investment risk. This diversification can be a safeguard against the volatility of the market, making index funds a less risky choice than putting all your eggs in one or two baskets. Historically, index funds have shown strong performance relative to actively managed funds. Over long periods, many actively managed funds struggle to consistently outperform their benchmark indices, making index funds an appealing alternative for those looking for reliable returns. All these benefits make index funds an attractive option for those who prefer a passive investment strategy. We keep mentioning passive investing, but what does that really mean in the context of index funds? Passive investing is a strategy that's all about playing the long game. It involves minimal buying and selling, aiming instead for long-term growth. Unlike its high-energy cousin, active investing, which dances to the beat of frequent trading and strategy shifts in hopes of outperforming the market, passive investing takes a more laid-back approach. So, how do index funds fit into this picture? Well, they are the epitome of passive investing. Index funds aim to mirror the performance of a specific index, such as the S&P 500 or the Nasdaq. By holding all, or a representative sample of the stocks in the index they track, these funds maintain a consistent investment strategy. The beauty of this approach lies in its simplicity and effectiveness. Since the fund managers are not actively trying to beat the market, the costs associated with trading, such as fees and taxes, are typically lower. Furthermore, the very nature of index funds reduces the risk of human error. No hasty decisions made in the heat of market fluctuations. Moreover, by investing in an index fund, one is essentially betting on the overall market rather than individual stocks. History has shown that markets tend to grow over time, making index funds a wise choice for the patient investor who prefers a set-it-and-forget-it strategy. Thus, index funds simplify investing and can be a cornerstone of a passive investment portfolio. We've explored what index funds are and their numerous benefits. Now, the final question remains: are they the right choice for you? Let's quickly recap. Index funds are celebrated for being cost-effective. Unlike actively managed funds, they generally have lower expense ratios because they're not trying to outperform the market. They simply track it. This can mean more of your money stays invested and potentially grows over time. Additionally, index funds offer incredible diversification. By investing in a broad market index, you're spreading your risk across hundreds, if not thousands, of stocks. This can be a safeguard against the volatility associated with individual stocks. And let's not forget, index funds epitomize passive investing. They allow you to set it and forget it, making them a superb option for those who prefer a hands-off approach to investing. So, consider your investment goals and your risk tolerance. Are you looking for a simple, effective way to grow your wealth over time? If so, index funds might fit neatly into your portfolio. Remember, the best investment strategy is one that aligns with your financial goals and lifestyle. Index funds just might be the tool you need to achieve them.